Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about his 2026 housing forecast for the 10-year yield, mortgage rates, and home prices. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast I have been waiting for months. We are going to get to discuss your 2026 forecast. The day has come.
Yes, something that I look forward to. God, let's see, it's like 14, 15 years now. I always do my forecasts at the end of the year. I take them very seriously. And I always say that, a forecast is wonderful, but, you have to be able to have a model to go with it so you can explain to everyone. I think 2025 was flawlessly beautiful in that sense, where you show people what goes on throughout the year. And when variables change, you go with it. But I'm very, very excited for 2026.
Me too. Okay. And of course, we've published your forecast on HousingWire.com. Listeners, if you're not a subscriber, you have to ask yourself, why? You should be a subscriber. Otherwise, you can never get Logan's total analysis. We also have an entire team of people who are writing incredible news information, analysis pieces, everything. But especially, you want to dig into what Logan is saying every week on the tracker, and especially for this forecast. So let's start. Logan, do you have like an overall theme for 2026?
Of course, going back through COVID, being like, hey guys, this isn't good. This is it's an unhealthy housing market, very unhealthy and savagely unhealthy. And for me, it was, being part of team higher rates in early 2021 was just the basic principle of, I got sick and tired of coming on TV back then and saying, hey, listen, we have to worry about home prices escalating out of control, not crashing. Right? Inflation is, going to be the issue, not the other way around. But I set metrics for myself. I said, as soon as we get inventory total active listings, NAR data, about 1.52 million, in 4 months plus of supply, we are back to a balanced, healthy housing market. And to me, 2026 is a tug of war, right? It's a tug of war that I've wanted to see for many times. It took a little bit longer than I thought it would, but buyers and sellers back at it again. It's no longer this seller's market. We've never had this issue before in the housing market post-World War II. We never had active inventory that low. Even if the supply and demand equilibrium or demand just stayed flat, it was a very unhealthy housing market. Now we're back to, at least for me, I know a lot of people still think active inventory is too low, but it's back to a normal market. So I think of 2026 as finally the tug of war between buyers and sellers, which I'd love to see. Sellers will not be forced into doing anything they don't want to do. 2025 was another good example of that, but I'm excited, man. I mean, I've been waiting for this for some time, and here we are.
That's exciting. Okay, well, let's take a little look back at 2025, because before we look at the next forecast, it's like, what did you get right or wrong about 2025?
2025, out of all the years I've done this, was as close to a beautiful symphony of economic music as you possibly could get. We had a lot of noise in 2025, Godzilla tariffs, firing Powell, all this crazy stuff day in and day out. But like what I've always said, homies, we don't flinch here. We stick to our guns. We stick to our weekly tracker data. And remarkably, everything kind of looked as close to as you're going to get in my lifetime, at least. Like I was joking with you that like I would retire right now. I would just retire at the top and just say, that's it. I can't get anything better like than 2025. So 2025, we just go back to the main key points. 10-year yield channels. Mortgage rates, we do channels. We don't do mortgage rate forecasting. Mortgage rate forecasting is not efficient. It's just basically a targeting rate. We want to teach people this. 470 to 380, right? 7.25 to 5.75. We started the year, the economy was perceived to be very hot, so the 10-year yield was above 470, and it needed that to occur. However, what's our theme, Sarah? Paper,
Oh
rock,
yes.
scissors,
I'm
labor.
sorry. I wasn't ready for which theme we were talking about. Yes, paper,
Yeah,
rock, scissors, labor
labor
over
over inflation.
inflation.
So when we went into 2025, we wrote that article, said the builders have a supply and demand problem. And what usually happens is you start to see layoffs and tied to economic cycles when manufacturing jobs and construction jobs are being lost. At the same time, it's never a good thing. So what happened throughout the whole year, no matter what reason we were given, inflation, treasury supply, we're broke as a country, Fed sounding hawk, whatever it was, for the third straight year, the bond market went with the weakness in the data. This year was very, very more efficient in bond trading than it was in 2023 and 2024. So throughout the whole year, beautiful looking chart. Oh my God, take a look at the 10-year yield from January all the way to December. Flawless, and it stopped, right? We got all the way down to 4% and it stopped going down. The bottom end range was 380. I think Sunday night, overnight trading, we had a 387 print. So we stuck in that channel. Mortgage rates, 7.26, 6.13%. So that was as good as you're ever going to get because of the reason why, right? The reason why is the labor market in 2025 was the lowest job growth in the 21st century. You had job losses in manufacturing, in residential special construction trade, and you also had residential people losing jobs until rates went lower. When rates went lower, again, just like in 2023, we're back up to post-COVID highs. So the flow of the data on the labor data looked as good as you could hope for. If the 10-year yield went below 380, my Hodor line, that's a different story. I lost that in 2024, but that's quickly went up. So that looked as close as you're ever going to get in terms of mortgage rates in the bond market.
Well, I wanted to point out your home price forecast because I think it landed exactly on what you said, right? So every week in the tracker, you're like, for my forecast, here's what I did for, here's the range for 10-year yield and mortgage rates. And here's what I said for home prices. And I think we landed exactly on that.
Do you know what I love about 2025 was like whatever the doomers are doing, that they're entertainers. They're not serious people. If you people haven't figured out these people are not serious by now, I don't know what it is. But after 2022, I thought let's engage them and have fun because these are not analysts. They have no working models whatsoever. But let's go back to 2024. 2024, the price forecast was for 2.33%. Home price growth.
Right.
Okay. So rates were elevated. Inventory was up. I lost my forecast in the mid part of the year because when mortgage rates started to head down towards 6%, I could see it in our data line that not only was the demand firming up, pricing was firming up. So I knew when I was going to lose my forecast, right? Kind of September, October time frame. I said, boy, I'm going to be too low. Of course, who's ever going to get exact to the thing? But 2.33% means real home prices are negative. Now this goes into this. What the hell is real home prices? I got to tell you.
This is very confusing because you talk about home price growth and then you're like, but real home prices are negative. And what do I always do? I'm like, Logan, what does that mean?
All right. I remember doing this in 2019 where I was on stage and I had my charts up and I was like, look, real home prices are negative. This is a positive. My God, people looked at me like I had a third head on my shoulder or, I had, vampire fangs. And so when people talk about real home prices being negative, nominal home prices make it very simple. Let's say home prices are up 2.33%, but inflation is running at 5%. Okay, that means on adjusted to inflation basis, home prices are negative, real home prices. But nobody really cares about that. I've tried it for 12, 13 years, and all people care about are nominal home prices and total payments. I get it, but as an analyst, we love that stuff. So it was weak, right? We 2024, but we ended up being up 4%. I use Case-Shiller, no one else. 2025. So you have to explain why. 2025 was even lower than 2024. Inventory was up, but we started the year off with elevated rates. So when rates are above 6.64, especially above 7, pricing gets weaker, but now we have more inventory. So what had happened was we started at a very high level on a year-over-year basis. I needed that year-over-year basis to keep on going lower and lower for my forecast to be right because I don't change my stuff. I know when I'm wrong and I'm right. But what occurred was we had a ton of people who have never looked at pricing ever in their lives starting to say home prices were going negative because they saw the month-to-month Case-Shiller index. And they said, this never has happened except for 2007. And I was like, rookie ball. And this isn't just the doomers either. There were some really smart people out there that were just doing rookie ball all year. I was like, oh, you guys are cute. In any case, what happened? Mid-June, right? The way we can track housing, we believe we're very prolific because we look current and forward. I was like, oh, the growth rate of inventory looks like it's peaking. And if mortgage rates go a little bit lower past 6 points, the pricing data would firm up. What occurred was, what did we say back then? We said, it's going to take 6 months for everyone to realize this. We are here December 30th. We're doing this podcast. Existing home sales hit a 9-month high. Pending home sales just hit a multi-year high. The Case-Shiller index was firming up for months and nobody cared to read it. We always think read is a good thing. And here we are. We started the day, Case-Shiller up year over year, FHFA up year over year, 1.7 around there, so the forecast was for 1.77. But the reason why, I care more about the reason, the data was firming up and we said it's going to take 6 months. Today, X, the devil's pit, silence. They saw the Case-Shiller index. They saw the pending home sales data the previous day. They saw the existing home sales. People were trying to dismiss the existing home sales like seasonal and non-seasonal. I don't know what the hell that was. That was embarrassing to watch. But here we are. It all made sense. This is why I talk about 2025 made sense more than I could probably ever imagine in that sense. We ended up just a little bit higher. Now, the one thing that I got wrong is that I thought we would have some negative year-over-year median sales price data in September, October, November, December. We should maybe get one more in the NAR data in December because the comps are high. But again, I don't see anyone talking about the high comps. Why? Because they're not housing people. And this is what happened. And on this very day, the whole, enchilada of the curve getting better hit demand, hit supply, and hit pricing. You are never going to get a more flawlessly symphony being played than that with our tracker data, because it was one of these years, there was a lot of crazy headlines, but everything kind of stayed, kind of within the ranges out there. And if anything ever turns crazy, prices escalate out of control or prices are really falling, we're there for everyone. This is why we say we are prolific because we don't care about ideology. We're not Redfin pushing headlines. We're here about the data. We flow with the data. So that's what it looked like for me in 2025.
And home prices. So every week on the tracker, you talk about home prices. And so all year long, I've seen, my 2025 forecast is growth of 1.7%. And wake up today, 1.77 or something like that,
yeah.
as far as like growth in home prices.
It's in the range. It's just, we had some questionable characters forecast the second and first biggest home price crash post-World War II. And again, I've always tried to stress this. None of these people are serious. They are entertainers. Because they are entertainers, they don't care that they're wrong all the time. The more they are wrong, the better, because they get people. So imagine they are laughing at all of you because they're thinking, why are these people listening to us? Because we're wrong, because this is what doom porn is, right? But this year was good because we had a lot of smart people who I believe did not read the housing data correctly out there. And there's a lot of people that want the Fed to cut rates more. So they use this analogy that you go back post-World War II, whenever home prices are declining, right, and we see the unemployment rate rising, the Fed is too restrictive. This is technically very true. We saw this in the early 1990s, and we saw this in 2007. So the Fed is always behind the curve. But except we didn't have any negative year-over-year data. And I was like, dude, what are you all looking at? Like, what are we seeing here? Like, if home prices are down 3 to 4%, we would see it in all the aptitude of all the data lines together combined, Case, FHFA, Freddie Mac, NAR. We would see them all together, and it just wasn't the case. So I understand the premise, but the variable was incorrect. And now that the pricing data is firmed up, we're almost at the end of the year. Case-Shiller and FHA lag 3 months, but the curve is better toward. Oh, it's flawless. It's like Hans Zimmer. They did a chart daddy Hans Zimmer symphony. It was beautiful.
Love it. Okay, well, let's talk about 2026. We're going to hit some highlights here. Again, everyone can go and read the entire forecast on HousingWire.com. Let's talk about the 10-year yield and mortgage rates for 2026.
Okay, now The 10-year yield, I can shave off 0.5% off of the top of the forecast in 2025. Why? Spreads, right? Mortgage spreads, something nobody knew about. And I was like, and part of me was like, I needed to do a better job a few years back about talking about mortgage spreads, but we've never had to worry about it or talk about it for so long. But not a lot of people have seen what mortgage spreads do when they start coming down. So 2024, I think there was only 4 of us that thought the spreads would get lower. They did. 2025, though, 27 to 41 basis points improvement in spreads using a 254 average. We ended the year off at 0.49. I can take 0.5% off the top end. So from 7.25 down to 6.75, 6.75, 460 on the 10-year yield would be the high end. 380 still holds, right? 5.75. It is very hard for me to forecast below 5.75 unless we have normal spreads or the Fed loses its neutral policy, right? They have a neutral stance policy, which is Fed funds rate is 3.25, whatever it is. It's not by accident that mortgage rates have not gone below 5.75. It's just 65 to 75% of this is Fed policy. So that's the range we're working from. But 21st century lows in job creation, and we weren't able to break under 380 on the 10-year yield, right? Inflation is almost 1% higher than what the Fed's target is. If we have a few reports that are over 100,000 jobs, the 10-year yield should go up under this Federal Reserve. There's no reason for the 10-year yield to be this low. The only reason it came down is because the spreads got better and the jobs data had the worst jobs growth in the 21st century. So the upside is if I'm labor over inflation, well, the inflation data is already up. If the jobs data gets better under this Federal Reserve, they should talk more hawkishly then. The only reason they cut an extra 25% from their original forecast is because, the jobs data got worse right in front of them and they look like they're behind the curve. So if you get a little bit of better data, there's your 460 on the 10-year yield. There's your 6.75. If it gets worse, if there's jobless claims breaking, which is the real recession data line, then you have the potential to get below 380 and under 5.75. But that is a channel for 2026, just like I do every single year, and just work off of that. And then every single day, I'll track every single data. I'm an economics person first, housing second. Man, we will keep an eye on this. If I see a recession in terms of jobless claims breaking, I'll go with it. But it has never showed up in the data line. I know 2022, all 6 of my recession red flags were up on August 5th, 2022, but the labor triggers never went off. Residential construction workers are back to post-COVID highs. Jobless claims are still near the COVID lows. It's still good enough to keep the expansion going. Once the labor triggers break, I'll go with it because, I was showing this chart to a lot of people over the weekend. If you look at the unemployment rate post-World War II, the unemployment rate, when labor breaks, it has more of a vertical move, right, higher. What's happened in the last 18 months is the unemployment rate has been rising, but the slope of the curve is very slow. When labor breaks, it goes vertical. When labor breaks, jobless claims breaks. That's what we've seen in every single cycle. So we haven't broken yet in the labor data. If it does, everyone listening, rates will go lower. Everyone listening will do more business because that's housing tends to outperform in a recession. Why? Because sales are usually low, rates go lower, and because of that other demand curve that's been held back, typically it comes up. Very similar to the 1980s, as I've talked about. We look more like the early 1980s than we do 2008. But the early 1980s had 2 recessions. The first recession, rates went lower, demand spiked up. Then the second recession, rates went lower, demand spiked up and went on for years and years. We haven't had that rate curve break lower. To me, it would be under 5.75%. So if that occurs, which I don't want, I'm one of these people, I do not root for recession for lower rates. But if that does occur, because sales are so low, everyone does more business.
Okay, so how do you figure in a potential, obviously we will have a new Fed chair, someone who's being pushed to lower interest rates. How does that figure into your mortgage rate forecast?
As I wrote in the article, 2026, for the first time in my life, will have an active sitting president try to install governmental policies to get the housing market in the biggest fashion I've ever seen. He is going to replace Jerome Powell with one of his own people. I'm hoping it's still Waller, but if it's Kevin Hassett, he's probably going to go after Fed governors. They talk about making the tax exemption from $500,000 to $1 million. We have state governors talking about getting rid of property taxes. There will be a housing, national security thing. I don't know what that's going to look like. That probably means more about supply. That's not going to impact 2026 data whatsoever. Anything on the supply side and construction is looking out years ahead. I have to see how the market reacts to this. So it is a X variable. It is a massive X variable, but I'm only going to deal with things that I know is in front of me until I see it. And then I got to see how the market reacts to it. Because if I believe 65 to 75% of it is Fed policy, then if he's able to fire governors and they get more votes, I mean, it's crazy for me to even say this, but this is what's being attempted here. We'll deal with that. We'll cross that bridge when we get there. But for now, I'm just simply ignoring all of that until I get it because, the 10-year yield looked pretty normal to me without any interference. A lot of people said that the more he talks about firing Powell, the bond market will reject it. It looks right? The labor data led to weakness. The spreads got better. If you didn't know President Trump was the president or any of stuff, you would say it's a pretty normal year out there. So we'll cross that bridge when we get there, when I'm pretty sure in January there'll be some announcements, and then we'll take it. But this is why the tracker is very critical every single week. Every single day we do this and we go with the data.
No, I appreciate that because all year long, of course, we had giant headlines about potential things happening. And to your point, how did it actually affect housing in the end? How did it affect the 10-year yield or mortgage rates? And so I think that's the prudent way to go. I think that was the number one surprise for me in 2025 is that those things didn't affect the bottom line for housing as much as I thought they would.
Yeah, well, you were listening to somebody that was talking out of character. But in any case, Godzilla is the bond market, guys. Really, the stock market is very small. The bond market runs everything. And here's a really good example. When the 10-year yield got down to 3.87% after Godzilla tariffs, what happened is that it made a very, very sharp reversal. Now, you could say that mutual funds were selling their bond market gains to raise cash, to buy equities, whatever. That's all good. But the 10-year yield getting up to 460 forced the White House to change because the bond market really runs everything. So what happened is that when the 10-year yield got a Bessent and them, Peter Navarro had to leave the White House. They go in there, hey, Trump, tweet this, right? And then what happened? Things started to calm down. So if we see a flare up in 2026, this is just, I'm speculating here. I imagine if Trump picks Kevin Warsh or Kevin Hassett and the bond market goes against him, they have already had a deal where they resign.
Interesting.
So because you can't fire a Fed governor, but they can't have the bond market go. Now, I've not seen the bond market really go against anything in my lifetime, but if that is a variable that people are talking about, if this is the case and the bond market goes against, I would imagine Fed Chairman Kevin Warsh or Fed Chairman Kevin Hassett will resign. Trump can't fire them, but they can resign. Christopher Waller will come in at that point, and then things will get normal. But if you're putting those people in, this is not like a dress you pick from Instagram and then try it on and you don't like it, you can return it. You're stuck with that person. And if the bond market goes against you, just saying, I believe there is a deal done that they will simply resign because Trump doesn't have that much time left, right? You can't sit here for another year or two. And, so if that's the case, which I'm very skeptical of that ever happening, but if that's the case, I imagine Warsh and Hassett would resign and Christopher Waller would be the next Fed chairman. He could just choose Christopher Waller and we could be done with all this, but Trump likes loyalty, likes his own people. So it is what it is.
We will see. Really interesting premise there. Okay, let's real quick, home prices.
Okay, so if I'm following with my slope of the curve, right, if I'm following with my own models that we got over 4 months supply and we're above, then I have home prices slightly going negative in 2026 if rates go back up higher, because that's what we've seen in the data. Now, I can be wrong here if rates stay lower for longer because the pricing data has changed. But even with the rates getting down to 6%, the pricing curve just firmed up just a little bit out here. So 2023, one of the things that we talked about back then is if home sales kept on crashing, right? If home sales kept on, you can have 5 to 7% declines because the supply and demand equilibrium was very stressed there. The theory that we had back then is that if home sales just stop going down at 4 million, why? Because it really doesn't go below 4 million no matter what since 1996. We have that data. Then all of a sudden, with rates going lower and demand picking up, the supply and demand equilibrium will change. And in 6 months, people will be too late to figure it out. That's kind of what happened. By when February came and we got the January existing home sales stopped going down. And then all of a sudden, in March, we got that February report of 500,000 more home sales. So that changed everything. Home prices ended up being up 6% that year. Here we have a little bit more. The negative side is if the employment data gets better and Fed policy gets more hawkish because they have no more weakness in the job data. So I'm just working off of that 0.62% decline. I don't do the ranges here because I want all of us to focus on the weekend tracker and go with that, because 2025 showed that to be the case too, right? In mid-June, everyone was so convinced that we'd see year-over-year declines, and by the time October, November, it just didn't happen because the data started firming up. And this way, everybody could be attached to real data, not a speculative theory, but real data. And again, the key to everything was new listings data. We've always said this from time to time to time. We've said this, when Mike Simonson went up to Lehman Brothers back in, I think, 2007 and told them, hey, homies, we have a way of tracking data, and it looks like the housing market is breaking. And Lehman said, I don't know who you are. I got 85 analysts. Go away. But Mike, the legend, went to Goldman Sachs. Goldman Sachs said, okay, looks really bad. Shorted the housing market, made $10 billion. Lehman Brothers went out of business. What have we done in the last 3 years? Like when I die, it's going to be 2023 to 2025, right? I got to test case my own model with real live data. And What happened was, in 2006 to 2008, inventory went vertical, new listings data, stress was all breaking out. But when you have the biggest and fastest sales crash, what does the inventory look like? We always say most sellers are home buyers. The inventory channel is going to look a lot different under qualified mortgage. We could explain this. Well, people have seen my chart of the NAR data for over 12 years now. But it should be a slow rise. It should never go vertical. Because if something goes vertical, the new listings data would go, well, guess what happened? May 23rd, 2025, the new listings data peaked. Never even got back to normal even. And because of that, the active inventory growth went from 33%, then now down 13%, slow down, supply and demand equilibrium. There it is. If something like that happens, we won't miss it. We'll tell you, but it really works with our new listings data. And the new listings data never broke in 2022, 2023, 2024, 2025. There was no Airbnb crisis. There was no podcast stock traders saying everyone's going to sell their house because they're broke. All these theories were here for the last 4 years, and not one time. We never even got above 100,000, actually. And when we do the tracker article, I say this thing was running at 250 to 400,000 per week.
You're talking about
years.
weekly
per
listings.
week for years. I think the last print was like 33,000. Like in 2010, I think it was like 320,000. So when housing breaks, you can see it with our tracker data, right? It's flawless because it's numbers. And what do we say about numbers, Sarah Wheeler?
Yes. Numbers are the closest thing to the handwriting of God.
Yes. Numbers are the closest thing we have to the handwriting of God. And it was just flawless the last 3 years. Man, I really want to retire. Like there's nothing else more I could do here. This
okay.
is it.
No, you're not allowed to retire. Do appreciate this. I know there's lots more detail, existing home sales, mortgage spreads in your in the forecast that's published on HousingWire.com. But thanks for talking through, especially mortgage rates today. I know everybody's been listening for that and wanting to hear what you have to say. So Logan, thank you so much for the work over the last couple of years, especially in 2025 and into 2026.
Yes, and for all of you here, trust me, I'm not going to fib. Trust the tracker. Trust that if something went negative or positive, I will tell you the truth. But I've got the last 3 years to showcase this, right? Yep. So be careful of who you listen to out there, because I don't want those people to think they're duping you all out there. Because I always say, you trust someone's forecast with their models, not with their constant doom-born thing, right? We have ways to track this. We believe we're the most prolific people on planet Earth. We are not shy about it either. So we can't wait. Tug of War 2026. Let's go with it.
Let's go.